uh, I don't know whether this is an actual risk, Mikkel.
No. Yeah, but
ETs, I don't know whether we should call it that, electric tanks. But
it's being worked on in a lot of places. This is this is of course hilarious. One of the major drawdowns or speculated drawdown of electric tanks and military vehicles is exactly that. It's tough to bring power to them. It's much easier to drive out and fill up a gas tank. So until there's an improvement in that, we're not going to see electric army tanks on any major level.
You're listening to Macro Sunday, hosted by Andreas Steno. Happy Sunday, everyone, and welcome to the Macro Sunday podcast. I'm Andreas Steno, your host for the next 45 to 60 minutes. And this week, we're going to talk about the worsening crisis in the Red Sea. And part of the logic behind forming Steno Research that I founded a year and a half ago, roughly, was to make sort of a joint venture between geopolitics and finance. And oh boy, that is of great relevance right now. And thankfully, I'm joined by you this week, Mikkel Rosenvold. Welcome to you.
Thanks a lot.
Partner here in Steno Research, but also our head of geopolitics. Given everything that's ongoing in the Red Sea, it seems like the situation worsens on a weekly basis. We're going to spend some time on the Red Sea again and the ramifications for inflation over the next 30 to 45 minutes. And in the middle of the show, we're joined by both our friend, but also our colleague, Emil Moller, for a discussion on China, given everything that's been ongoing from a political standpoint in China over the past week. We've seen plenty of action, both on the monetary side, but also on the fiscal side. Is it a biggie, the news out of China? We'll have that discussion in a short while. But before we get to China, Mikkel, why don't we basically start out with the Trump soundbite of the week. One of our favorite moments week in and week out. The true president of the United States, as he would claim himself. Trump's got an opinion on right about everything, including tanks. So here's Trump on the risk of the Democrats electrifying the military.
Electric army tanks now. Think of this. So they want to have an army tank that's electric. You can't get it recharged. It doesn't go far enough. It doesn't go strong enough. But they want to have electric. So that we go into enemy territory. We will blast the shit out of everybody. But at least we will go in with environmentally nice equipment. Now, do you believe it?
I don't know whether this is an actual risk, Mikkel.
No. Yeah, but
ETs, I don't know whether we should call it that, electric tanks. But
it's being worked on in a lot of places. This is this is of course hilarious. One of the major drawdowns or speculated drawdown of electric tanks and military vehicles is exactly that. It's tough to bring power to them. It's much easier to drive out and fill up a gas tank. So until there's an improvement in that, we're not going to see electric army tanks on any major level. But it's a nice scapegoat. It's what a great analysis.
Yeah, you gotta love it, Mikkel. Joking aside here. Everything that's ongoing in the Red Sea now is obviously watched closely in Washington, D.C., ahead of the elections later this year, but also given that we're now seeing basically direct attacks on cargoes with equipment for the U.S. Navy. That's essentially what we've seen over the past week. Is this a new escalation by the Houthis in the Red Sea?
I don't think it's necessarily a new escalation. They've been firing at all sorts of container ships and firing at U.S. naval vessels. What's really significant about this is that the U.S. tried to escort the two Maersk ships that were attacked, and even with what I call direct convoy support, that they were sailing frigates right almost right up next to the container ships. The container ships were fired at, and they turned around. So this is very symbolic, because even with such massive naval presence, the shipping companies are clearly nowhere reassured enough to go through the Red Sea again. So you can go read my articles about what I've called the solution matrix, how we're going to get out of this mess. Originally, the plan was to reassure shipping companies to go, okay, this is safe now. We're clearly miles away from that. So in my opinion, the most likely solution to the Red Sea crisis is a peace between Israel and Hamas. That's basically the bottom line right now. And the time horizon for that, well...
But Mikkel, over the past week, we saw headlines, especially out of Israeli medias, on a potential ceasefire deal brokered by the Egyptians being rejected by the Hamas. Is that a correct story? How do you see this negotiation on a truce?
It's tough to say how correct it is. I think what's very clear right now is that the U.S. is working very, very hard to broker a peace deal. The U.S. has managed to engage Qatar and Egypt, first and foremost Saudi Arabia. Egypt, let's remember, has a massive incentive to get this mess solved, because they are losing out huge amounts of direct U.S. dollar income through the Suez Canal. It seems like both Hamas and Israel are unwilling to give up right now. Hamas are in an okay position. I mean, time is working for them, because Israel is losing the will to fight much more rapidly than Hamas, even though the civilian population in Gaza is taking such a massive hit. At the same time, Israel has been reported to also reject some peace offerings, but the pressure is really mounting on Benjamin Netanyahu here. The U.S. is pressing hard. Internally in Israel, the political opposition is pressuring hard for peace deals. It's getting increasingly tough for the Israelis to explain that this war will be over when we destroy Hamas, because they're nowhere near destroying Hamas. There's no realistic prospect of them destroying Hamas in any way. So it's really a pickle for the Israelis. To put it cynically, you could say that they have stepped into the trap that Hamas set up for them, and now they're trying to find a way out of it, possibly. I think we will see some sort of peace deal, truce deal, within 1 to 2 months, but it's really, really tough for Netanyahu, because once this war is over, he's out.
Yeah. If we look at the current status in the Red Sea, basically crossings of container ships through the Suez Canal are converging towards zero, at least outside of Russian ships. And we now see spillovers to the dry bulk space in particular as well. Much fewer crossings than we typically see. There are also early signs of spillovers to the price of the so-called Dirty Suez Max Index. So again, here a gauge of medium-sized oil tankers through the Suez Canal. So essentially, this crisis is widening. Even if we assume, Mikkel, let me just put emphasis on that. Even if we assume a peace deal within a couple of months, it's quite likely that we will have what I call a traffic jam in European and US ports as soon as these canals are open. We're also talking about a malaise in the Panama Canal, by the way, because of a sudden jam of ships basically traveling different routes towards the same ports as soon as the Suez is effectively open again. So, I mean, this will take probably at least a quarter to 4 months to fully abate, even if we're relatively optimistic on a ceasefire in Israel. I mean, it has to have ramifications for inflation over time, this, Mikkel.
Absolutely, especially when it begins to spill over into oil and gas prices. That's a very heavy inflation driver and hits all sectors, basically, for Western economies. One thing to note in the geopolitical sphere, Ukraine has begun directly targeting the Russian energy infrastructure now. They're not only targeting military installations and sometimes civilian population, but they're going after LNG terminals, oil refineries, that sort of thing. And although it's the Russian energy infrastructure is of huge proportions, so a couple of strikes will not damage too much. But even if, let's say, Russian energy production and export capacity is down by, let's say, 10%, it could have huge implications on global markets. Even if we don't buy energy oil in Europe, I mean Europe, we don't buy in Russian energy directly. We are buying some of it through third parties, and if China and India have access to less Russian energy exports, they will start to buy it from the markets that we're buying from as well.
Yeah.
So this is a huge, could have huge implications if Ukraine keeps this up. It also kind of shows that desperation, because this is not a popular move neither in Europe nor the US, but it shows that Ukraine feels that they need to do something to pressure the EU and US to decide on whether to support them or not.
Yeah, and if we look at the ramifications ahead for US inflation first, we typically see a lead lag pattern of, say, 4 to 5 months between the increase in the freight rate until we actually start to see sort of more widespread signs of goods inflation in the US. And how much of a goods inflation should we expect just because of this Red Sea story in isolation? The IMF released an interesting study on freight rates relative to inflation in the aftermath of the 21-22 supply chain crisis. And they conclude that for every doubling of the freight rate, you should expect an increase in the overall inflation index of 0.7%. On our own estimations, we should probably expect goods inflation to be back above 3% in the US by late springtime. That is a whole lot, given that we're currently stuck more or less around zero. I mean, goods inflation was gone until this started emerging in the Red Sea. So we need some substantial disinflation in services to sort of counter this. And I'm not overly convinced that central banks are comfortable with this situation at the moment, given what we've heard from various G10 central banks. It's not as if they're fully committing to the rate cutting cycle right now due to this uncertainty, and I get why. We'll get back to the inflation numbers out of Europe next week after the interview with Emil on China, since there's clearly a divergence or a discrepancy between what happens today on inflation. That's not particularly related to the Red Sea, and what happens in 3 to 5 months from now because of the Red Sea malaise. What the IMF concludes as well is that, interestingly, in sharp contrast to the oil price, the spillover from freight rates to consumer goods is a bit more lasting, and it slowly but surely builds. It's not as if a freight rate transfers directly into the price of a good day one. It takes 4, 6, 8 months for it to fully sort of pass through the system. And therefore, this is kind of a sneaky inflation effect over the next couple of quarters. But Mikkel, one thing I'd like to discuss before we invite Emil to discuss the Chinese stimulus this week. The consumer in Europe and the consumer in the US, the health of that average consumer is pretty important for the inflation discussion here. And we know 1st of January, we have the cost of living adjustments in the US, and they pretty mechanically add spending power to the US consumer.
Absolutely, absolutely. It could be a dramatic influence on inflation. I think it's a topic that many people are sleeping on right now.
Yeah.
Could be a major driver in the short term that then gets overshadowed perhaps by the Red Sea effects, but it could be several stepping stones. In lots of countries of Europe, we've gotten rid of these cola adjustments. We had them huge cola adjustments in Denmark. It was a huge step in building a healthier public finance, basically. That's another story, but it could be a huge story in France as well.
Yeah, and just to clarify, the cost of living adjustments, they're basically designed to shield the average sort of receiver of social benefits, for example, from inflation. So in the US, if you're on Social Security, you will get an automatic increase of roughly 5.4% as of 1st of January. That's basically an increase in your sort of purchasing power day one, because it is designed to sort of shield you from inflation over the course of the year in a sense, right?
Which creates inflation.
Yes, exactly. There's an embedded sort of circularity in this. There is one country with a sort of similar structure in Europe, namely France. Not a surprise, really. No. We've seen increases to the benefits in France of 4.8% by 1st of Jan here. So there are similarities in Europe, but it's not across the Eurozone, this kind of automatic inflation math, but it's very, very embedded in the US system.
Absolutely. So we're seeing quite the divergence in inflation trends. Also, how you view it from the US to Europe, I think that's very remarkable. I think a lot of people in Europe are beginning to talking like the inflation crisis is over. Might be in Europe, but it's definitely still ongoing in the US. Seems like.
Yeah, I would agree with that. Despite the softness that we see in PC numbers and all that from the US last week, Mikkel, it's time to introduce Emil Moller, our head of research, and an old EM guy. He's been both trading and analyzing EM for years. And given the announced cuts to the reserve requirements in China, given rumors of state funds trying to prop up equity markets, and given quite the party in Chinese markets over the past week, let's invite Emil to the Macro Sunday podcast. Loyal listeners of the Macro Sunday podcast will know the voice that I'm about to introduce now. Emil Moller, head of research here at Steno Research. Today, the guest of the week.
Disloyal employee.
Thank you for joining us, Emil. I mean, it's been quite the week in China. That's essentially the theme of this interview discussion, because you obviously track the emerging market space for us, and it's been probably 12 to 18 months of ongoing cry wolf scenarios out of China when it comes to the rhetoric from officials. So the package announced this week from China, is it one we should trust?
I think we should take the commitment, that is to say that we are going to move on it now. I think you should take that part of the statement at face value. When it comes to actual nominal sums and the sheer size of the efforts they're going to implement, I think that's still debatable. You shouldn't at least expect that they are, that the leaks and the rumors and everything else coming out from Chinese policy officials and to mainstream media, that those figures are lower than what will actually be the case once we see some actual evidence of policies getting implemented. So clearly, there's an incentive to basically prompt up markets here, and that's the first tool in the toolkit that they're rolling out here. So yeah, things going on.
And Emil, at least we know with a very, very, very high degree of certainty that the triple R, the reserve requirements for Chinese banks, will be cut by 50 basis points by February. Yeah. That's a liquidity injection, but it's not a rate cut. No. So what do you make of the lack of rate cuts, but continued liquidity injections? Why that cocktail?
So I think it's basically the case of an extension of what they did last year. I sort of view the 2023 policy prioritizations that they basically unveiled throughout the year as basically just going on now. And what you saw last year at every turn that they could, they tried to cut the capital requirements ratio, because that's basically their preference. Reason being that they have a need for liquidity coming into the system to basically solidify the balance sheets. But on the other hand, they don't really want to weaken the one, which eventually will be the case if you add more liquidity in using other instruments. So that's basically what you should be looking at here. But still, I was a bit surprised that they didn't cut rates early on this month. I think markets were as well, but I'm not at all surprised by them actually cutting the reserve requirements ratio, although I'm a bit puzzled with how they announced it. They rarely do so in such a dramatic fashion, I might add. So they're definitely emphasizing that urgency here is on the menu. But yeah, you should be cautious. This is treacherous territory, to say the least.
Yeah, and the People's Bank of China was very relatively vocal around this decision making. We even saw how they explicitly referred to an expected explosion in credit growth through the first quarter, while they tried to sort of dampen expectations for credit growth further ahead. So this potential for a credit growth explosion in the first quarter, if they're right, sounds bullish for commodities, doesn't it?
yeah. And I think we caught this in the early innings. I think the signs were there for you to see if you paid attention. I mean, the import quotas for oil were increased substantially for this year. And that usually spills out to the rest of the commodity space. And I saw that as an early sign that they will want to, at the very least, start to prompt market by saying, "Listen, we're doing something here." So, what was the downside of buying into this? I thought it was quite low, at least if you played this through commodities as we did. I still think if you do it through equities here, I mean, fair enough. It's probably gonna. I mean, I wouldn't be surprised if we see more positive price action in the coming weeks, but drawdown risks are substantive. So, yeah, stay cautious. That would be my advice. I mean, you only need like one unsubstantiated source for Bloomberg to basically just pull the rug beneath everything, because so far it's basically just funding news. That's what you're buying into.
Yeah.
So
I mean, we're obviously in the money on this copper bet that we've taken already. There are signs of this at least light restocking cycle commencing in China through the first quarter here, but it may prove short-lived. Emil, why is the medium-term outlook still not pretty for China?
Because they're not dealing with the actual underlying issues at all. I mean, the sell-off in equities that we've seen over the past weeks until recently was basically just a symptom. I mean, the underlying economy is clearly deteriorating. They're unable / unwilling to actually address it. And as long as that's going to be the case, that divergence is going to be tricky. And I would assume that what we saw last year is basically just the playbook. China is going to continue to be a deflationary source to the world economy. They will shoot out vehicles, toys, whatever goods exported at subsidized prices. So that sort of counters that whole freight rate surge to some extent for this year. And I think that's going to be the focus and the target for their policy efforts. It's pathological, but that's nonetheless what they will be doing.
Yeah. In Emil, if we look at goods pricing, at least China used to be a very important source of goods reflation and deflation, depending on sort of the credit cycle of the Chinese economy. Is it as important as it was 3-4 years ago?
So there are two answers to that question. For China, yes. China is even more sensitive to global goods demand now than they were 4 or 5 years ago. But I think if you look at US and to a certain extent European sensitivity, we are less exposed to China than we used to be. That's probably going to be a trend. But here's the thing, right? So if that pattern continues, it will basically just incentivize the Chinese policymakers to push out more stuff from the factories, which eventually, I mean, if you get more goods in the global economy, that is deflationary, no matter the trading routes, right? So that's something to keep in mind. And I will also emphasize that, I mean, I see a lot of people getting China wrong because they tend to think of, for instance, the People's Bank as some sort of independent central bank, as we know from the West. But no, everything is done diligently accordingly to a central planned policy framework. So whenever you hear them promising something, it's not like one of our students, making a pass on a girl in a pub and it going wrong, and you can just be careless because you're never going to see that girl again. In China, they don't care. You have to think of it from a very cynical perspective in game theoretic terms. So that's why you risk getting one-footed, and I've been so in the past as well. But I think I've have a decent record, and then this call is another addition to it.
At least for now. Don't jinx
Yeah,
it.
yeah.
I mean,
Famous last
since
words.
we're putting actual money behind this, then there's no reason to jinx it.
No,
we're not just
fair
talking
enough.
as a lot of other macro shops do. But Emil, the final story I want to touch upon is this so far rumored sort of substantiated buying of equities in the mainland Chinese indices by state funds. We don't have firm evidence of flows actually being sort of put into markets, but what do you make of this story on state funds now trying to sort of increase the asset values here and there?
So I think there are some evidence that they have intervened, but probably at quite modest levels. But what you're seeing now is they were promised to do more on that score. And what that should really tell you is that they're concerned about the sell-off. I think from their viewpoint, it's not necessarily, say, the wealth effects, which we know from the US in particular, right? Whenever equity prices increase, people take on more leverage and spend in the economy and whatnot because that they are exposed to those valuations. That's not the case in China. Instead, the wealth effect usually is more explicit in the housing market, which is still dire straits. So I think you should more look at it from a balance sheet logic here, where lower equity prices essentially pushes the financial system, which is already fragile, and it also dampens labor demand. And in contrast to the rest of the world, China actually has plenty of labor ready on the sideline. So I think that's the concern here. But they don't really want to commit in any substantive manner to the extent that they can avoid doing so, because there's so much bad leverage in the system. So that's why talk is cheap, basically.
Yeah. So to sum it up, Emil, this is another bear market rally.
Yeah, but you don't care about whether it's a bear market rally or not when you look at your P&L. So if you can catch this in the early innings, you know it's fine. But you should, exactly due to the absence of fundamental efforts, be cautious. And still, I mean, the 2023 the 2023 playbook is going to be the playbook until it's not. And I believe that at one point we're going to reach a threshold where they just won't be willing to stomach any more pain, and they will essentially pivot on some policies. So it's an interesting crossroads that China finds itself in on the economic front as well.
Yeah.
At this point.
And we'll promise to keep you posted on everything out of China to the extent that we're actually able to gather true intelligence. But for now, a bear market rally worth jumping, it seems.
Definitely.
Emil, thanks for joining us again this week. Next week, we'll have you back as my lieutenant through the show. And let's see whether China is crying wolf once again or not. I guess we'll have more evidence on that in a week from now.
Definitely.
We're back from the interview with a good friend and colleague, Emil Moller. Mikkel, I mean, China is always a dark horse in relation to global macro and global geopolitics. But one thing that strikes me is that we've been talking about the Suez Canal, the Red Sea, for a month without mentioning China. Do they even care about it? What's your kind of sense of what's ongoing in China related to this shipping issue?
It's inevitable that they care about it a lot. I mean, they are one of the countries that have other ways of transporting goods. They can sail Shanghai, Los Angeles route. But that route is obviously affected as well. There are capacity issues and overflow issues. So China's biggest problem, in my view, in this, from a political standpoint, is that they're simply not used to nor have the capabilities to engage in naval operations such as the U.S. So they've basically left the chessboard to the U.S. In the canal here. China could leverage more of the influence on Iran, but that's still very, very tricky for China to do. So it's a complex situation for China because there's not a lot they can do. They can't go in and attack the Houthis. They're not really there to support their ships, and it's really a bad look for them. We talked about this a couple of weeks ago. I think this in the global picture for global South countries who are being pulled both towards the US camp and the China camp, being influenced by both countries. This is a really bad look for China because they're basically not doing anything to support international trade or to support the flow of goods to these countries. So it's definitely a problem for China. This
one of the great friends of this show, Daria Perkins of T.S. Lombard, sent me some data the other day on the sort of spending as a percent of GDP on securing global shipping lanes, and it's essentially just the US securing them. You have a bit of spending on this in the UK and France, stuff like that, but it's 0.2% of the entire national budget in the US used, solely for the sort of shipping lane security globally. That's a lot.
It is, and it's a stark contrast to the Chinese marketing fronts, like the Belt and Road Initiative, String of Pearls, all that. They've been trying all these initiatives to try and steer global trades in their direction, to control more of the global flow of goods. But then when shit hits the fan, if you'll allow me, they're not there.
No, they're not.
They're not picking it up.
No, but Mikkel, if we look at sort of the most directly impacted shipping route right now, the benchmark route between Shanghai and Rotterdam, we're talking about an increase in the freight rate of 350%, but we're also talking about delays. So let's focus on the European side of the equation for a moment here. We've received new weak numbers from Germany last week. The IFO survey is weak. The outlook is weak. And I know you've basically have some observations on what's ongoing in relation to this Suez crisis in the German economy.
Yes, absolutely. We're following that closely. I think it was the finance minister Christian Lindner who was asked some time ago, is Germany the sick man of Europe? And he said, no, we're not sick. We just had a little lull. We need a cup of coffee. So that's the prognosis here. No, I mean, Germany will be one of the countries hit the hardest, I think, in Europe from the Suez crisis or the Red Sea crisis. We've already heard reports about a Tesla, I don't know if it's a mega or giga factory. It's always called something like that with Tesla, in Berlin shutting down on Monday. So that's one of the, because of a lack of components, basically, and that's going to hit the German manufacturing industry heavily. So that's one of the first dominoes to drop, basically, I think, in German manufacturing. At the same time, as we're talking about lack of growth in the German economy, Germany as the sick man of Europe, the German workers are pushing for higher wages all across the board, and we have a train strike going on right now. So it's a very, very complex situation for Germany. We're looking into an election next year. We have a European election this year, which is also really big in Germany.
For the parliament in Brussels.
Yeah, exactly. And then next year for the German federal election, that's going to be really interesting because we politically we see a lot of upheaval in Germany as well. We have huge demonstrations against the right wing AfD party, but still their poll numbers are really, really impressive, are rising. So I think politically Germany is being drawn towards the political flanks, both AfD in the right and Die Linke, and possibly a certain woman called Sarah Wagenknecht to the left, to the populist wings of the political spectrum. And that's natural, given all the upheaval in Germany and all the unemployment and lack of growth. The question is, can these political flanks deliver the economic reforms that Germany need?
Probably not, but I mean, Sarah Wagenknecht officially launched her so-called Bündnis, so coalition around her on the very left of the political spectrum in Germany. And if you combine her polling with the polling for AfD, I think we're talking about 35% or so in the most recent polls. That's a freaking lot. They have a couple of things in common, it seems, namely a slightly more constructive approach to Russia.
Absolutely. It's they're both staunchly against, not against the support of Ukraine, but they're opposed to continuing and expanding the support for Ukraine.
Yeah.
And are pro-peace, they would probably call it themselves.
Yeah.
So that's one thing they have in common. The other thing is the immigration stance, which is a completely new thing for European left to have, more or less anti-immigration policies introduced to that part of the political sphere. So people are drawn to these. This is probably seen as solutions to the economic woes of Germany, but in my opinion, that is a little bit naive, to be honest.
The trigger of this rise in opinion polls for the right and the left could be the inflation issue in Germany.
Absolutely.
And it's time to look a bit ahead in terms of January inflation in Europe. This will be a key economic release, and I cannot stress it enough. So what's the consensus out there? Well, the consensus is relatively soft, I'd say, both for Germany, Spain, France, Italy, etc. The projection from the European Central Bank is off by miles. I think that's relatively safe to say, also given the opinions from other economists. But yet, we're now casting here at Steno Research. We're actually running regressions based on price observations through the month, and we're leaning clearly on the soft side of inflation consensus again. For Germany, just to take an example, our nowcast is at minus 0.54. That's roughly 15 to 20 basis points below the market consensus. So let's see here. We had it a little bit off in December due to a couple of service categories, but we had it spot on basically from August until November. No forecaster with a larger prediction than us globally, I think. So yes, again, we're leaning on the soft side based on actual price observations. Will be very interesting to see, especially you need to watch out for a couple of categories here. Clothing and footwear, recreation and culture. Typically categories with large discount seasons. Those discount seasons were kind of off during the pandemic due to everything related to supply chain distortions, etc. The Red Sea malaise is not impacting this January. Let's just stress that. Inventories are large enough to cover it and all that. And well, the malaise started late December. So, I mean, we're talking about shipments basically designed to deliver the products for the months ahead. Point being here that January can be very soft despite all of the supply chain issues. And I think it will be a major surprise to markets if it's as soft as we think. Also given the lack of sort of true willingness for the European Central Bank to even discuss a rate cut. That's kind of still the case. Markets are pretty convinced that March is off in terms of rate cuts. So this is the thing to watch for the week ahead in the economic landscape. In terms of trade updates, Mikkel, given the discussion I had with Emil earlier, we're still invested in the copper sphere. So basically a proxy bet on China now actually at least delivering parts of what they're saying. This is not a complete cry wolf event. We're received in the euro curve versus the dollar curve, basically betting on lower 5-year interest rates in Europe relative to higher 5-year interest rates in the US. I bet on this divergence in inflation trends. And then we're still heavily invested in the tech space in the US equity market due to this dollar liquidity addition that we've been rambling about for weeks. Over the past week, the Federal Reserve finally communicated that the bank term funding program will end by mid-March, and also they communicated that the interest rate on the BTFP will now match the interest on reserve balances, meaning that there is no arbitrage possibilities left. That was kind of a blunder, if you ask me, that they didn't do it earlier. A lot of regional banks basically secured a safe arbitrage through this bank term funding program. There were no reasons to allow them to do so. Well, they're always slow to react, central banks, aren't they? Mikkel, when we're back here at the Macro Sunday in a week from now, any good news on shipping over the next week? I mean, Wouldn't that be a surprise by now?
Absolutely. For me, it would be a huge surprise. And the only thing I can think of as potential good news is a peace deal between Israel and Hamas. That's a lot to ask for. There's a lot to wish for in just a week's time. The pressure is mounting. We're working towards that end, and it is the most logical solution to this crisis at this point. But it's
no boots on the ground in Yemen.
No. That's a complete no-go. I think we're likely to see increased U.S. military activity. We know they're trying to build a coalition for increased, could be aerial bombardments instead of only missiles. But I mean, no, the U.S. isn't going to invade North Yemen. And really, what would that solve? I mean, it's going to be really, really tricky to contain it to that. So no. My biggest fear is increased spillovers into energy shipping, basically oil and LNG especially. Also with what we talked about in Russia. That's my biggest concern of what could really drive out this crisis.
Mikkel, I'm truly looking forward to the Macro Sunday podcast in a week from now. We'll be joined by Jacob Shapiro, one of the best geopolitical analysts worldwide. He's got a tremendous network in Washington, D.C. So we're going to cover sort of the U.S. angle of this Red Sea debacle next week. What's the strategy from the White House? Jacob is a great friend of ours, and thankfully we'll be joined by him in a week from now, hopefully with better news, but who knows? It seems like we're kind of in a status quo, if not even in a worsening scenario in the Red Sea currently. But remember, status quo is bad enough.
Yeah, it is.
For every week that passes, we should expect higher prices on goods, I think.
It's a time bomb for consumers, essentially.
It is. It truly is. I guess with those words, we're slowly but surely moving towards the conclusion of this Macro Sunday podcast. Remember the best disclaimer in the world. We always forget about it, but here it is. Before we conclude the show, when we talk about our trade ideas, please bear this in mind.
Sometimes it may be good, sometimes it may be shit.
Gennaro Gattuso referring to our trade ideas here. Mikkel Rosenvold, great seeing you again.
Likewise.
And great seeing you out there. Thank you for watching or listening to the Macro Sunday podcast. We'll be back again in a week from now. My name is Andreas Steno. Please visit us at stenoresearch.com or take us up on Bloomberg if you're interested in an institutional coverage.